Hello, everybody. Welcome to week four. Let's just get right started. So, couple little logistics before we start with our material today. This will be a longer lecture, but there's only going to be one lecture for week four, so you only have to make it through this video. The midterm is going to be Wednesday, July 23rd. This is going to be in class. The class will be held on Zoom. And then the time for this is 3:30 p.m. and this is Pacific time. So after this lecture, probably when you're looking at it, there will be practice midterms for you to look at. And how the process is going to work for the midterm is you're just going to join the Zoom meeting. I'm going to open up the assignment with the midterm file, and then you'll just have the entire time to go through, complete the midterm on a separate piece of paper, scan the midterm, and then upload it, turn it in to Canvas. Okay, homework. Quiz 10 is due Sunday. So this says quiz 10, but this is chapter 10, not the 10th quiz. That's due Sunday, so that's the last homework that you will have before your midterm. Essay one is due Friday, July 25th after the midterm. Like I said a lot of times already, it's probably beneficial for you guys to get this done maybe before you even start studying for the midterm. So sometime this weekend or whenever you're seeing this video, if you have a couple hours, I would just go ahead and get this done. So last thing I want to say, just to emphasize, this is the last material that's going to be covered on the midterm. So your midterm is, I guess I'll make a note. It's from week one material, uh, all the way until this lecture. So after this lecture, you'll have all the material that I could possibly test you on. Again, there's going to be practice questions, so you'll get a feel for what I'm going to ask. But next week, I'm going to upload a lecture and I'll make sure to emphasize this when I do, that will not be covered on your midterm. All right, so what are we talking about today? Today, we're going to be talking about financial markets. So, financial markets, it's a market in which the government, firms, and individuals trade promises to pay in the future. Why is this important? So this comes to be important because it's a way of raising capital through stocks and bonds. The ability to borrow other people's money is extremely important for growth. For example, if I give you $10 and you take that $10 and you start a new factory in, say, Nebraska, that's going to be beneficial to the entire economy because this investment means you're going to hire people in the future. You're going to be able to produce goods. So we're kind of like starting before the production is possible, you need investment to get there. All right, what are financial assets? So this should be pretty common to you guys if you've have a bank account or any of that. But let's go quickly through this. We have loans. So lender agreement made between an individual lender and an individual borrower. If I give you a loan, that means that you owe me X amount of money in a set amount of time. So say like a year. I'll give you $10, and then next year you have to pay me back $10. What are bonds? Bonds are issued by the borrower. Seller of a bond promises to pay a fixed sum of interest each year to repay the entire principal. Then we have loan-backed securities, which is an asset created by pooling individual loans and selling shares in that pool. So mortgage-backed securities are a popular example. Usually use this to buy a house. And then there's stocks. So stocks is a share in the ownership of a company. I bet you guys are all familiar with stocks. This is like you have the S&P 500. That's a group of the 500 biggest firms that trade on the New York Stock Exchange. Uh, so yeah, we're kind of going to learn a little bit about how all these all these important types of assets work. So, what's a financial intermediary? It's an institution that transforms funds gathered from many individuals into assets. So, some important types of financial intermediaries. There's a mutual fund, which is a financial intermediary that creates a stock portfolio and then resells shares of this portfolio to individual investors. Um, so, like on the stock market, QQQ is a pretty popular one. SPY is another one. Basically, what happens is there's a really big bank. They buy a ton of these stocks, and then they group them all up. And then you, as an investor, you go and buy like one share of QQQ. And one share of QQQ is gonna promise you that you have like a quarter of a share of Tesla, you have a quarter a share of something else, and there's usually like a lot of stocks involved. It's like up to like around 100. I'm not exactly sure about that number. What's a pension fund? It's a type of mutual fund that holds assets in order to provide retirement income to its members. People who are likely to receive pension funds are those actually in the public sector. So teachers, like your high school teacher, is going to have a pension fund if they teach for a certain amount of years. Firefighters, police officers, all that. So you don't need to know these like terms for the exam, but I think it's just kind of important to know. All right, so let's get back to kind of like more theory, more mathematical equations. How can we make sense of this market? So what is savings? It's the part of income that isn't spent. So if I make $10 and I spend $6 on Oreos, that means I'm saving $4 because $4 is what I haven't spent. So the question is, what do I do with this savings? So remember income, we denote that as Y. Consumption is always C, and then savings is going to be S. It's, we don't even have to make any assumptions here. This is kind of just a fact of math, that this is how we just define savings. It's just all the money that we don't spend that we make. Okay, so we can rearrange this equation by just simply subtracting C onto the other side. And now we have a nice clean equation for savings, which is income minus consumption. So it's whatever's left over after consumption. Okay, so now let's go back to the GDP formula. Remember, this is like a big thing to know. GDP equals C plus I plus G plus net exports, which is exports minus imports. So this equals Y, which is the GDP. So imagine that government spending is zero and we are completely closed off, so net exports is zero. Then we can just rearrange the equation, not even. It's just this first half of the equation, and it's Y equals C plus I. So a simplified national income accounting identity, we can write it as the investment is equal to the income minus consumption. So since we already know that savings equals Y minus C, we get savings equals investment. So this is again strictly by definition. What this tells us is if I have $10 of income and I spend $6 to buy food, and then I have $4 left over, whatever I choose to do with that $4, that's how much I'm going to save, and then I'm going to choose to invest that. If investing can just be putting it underneath my pillow, it can be putting it into a savings account. Investment can be kind of like loose in that way. Okay, so let's add government back in. So if we add government back into our GDP formula, it's C plus I plus G. So what else does the government do besides buy goods? They tax and they borrow. Okay, so taxes reduce income available for spending and saving. So we have disposable saving, which is Y minus T, and then we have private saving, which is Y minus T minus C. So if I make $10, but I have to pay $1 in taxes, remember T is going to be, we're going to define that as taxes. That means my disposable income is $9. Okay. This is income. Okay. And so we can just subtract how much I spend, and that's going to be the private savings. So say my income is $10, my tax is $1 on that income, and then I spend $6, then 10 minus 1 minus 6 means my private savings is $3. So what does government do with T? Well, what they do is they take your tax revenue and then they use it to buy goods. G does not mean goods. This is government spending. So they spend the money that we give them. How they spend it is a question that we're not going to get into. Right now, we're just assuming that the public savings is going to be how much taxes they get minus how much like they choose to consume with that tax revenue. So we can look at national savings. Again, we're going to start with our GDP formula without net exports. We are going to solve for I. That's what we did in the second line. In the third line, what we're going to do is we are going to subtract how much we pay in taxes, and then we're going to add it back because we're giving it straight to the government. So this gives us remember, this is our private savings. We can add that with the public savings, and that gives us the total investment. So national savings equals private savings plus public savings, and national savings equals the total investment. Okay. And all we're doing here is we're just taking our GDP formula and we're using definitions. So definitions of savings, disposable income. We're doing all that to arrive at these three kind of nice results here. Okay, so let's look at America's low savings. Another nice graph with fancy colors. So we have 2007 savings rates as a percent of the GDP. The United States is low. Japan is very high. And then you see like this upward trend of a bunch of other countries that are pretty good comparison to us, even though they're not as large as us. They are structured similar ways. So the United States has a pretty low savings rate given our percent of the GDP. Okay, so now let's throw in exports and imports back into our equation. So remember, exports are products that are made here and sold abroad. So this is like the United States selling computer chips to Germany. And then imports are products that made abroad and sold domestically. So if we're talking about the United States again, that is China selling t-shirts to the United States. So in the GDP equation, net exports is the difference in value between what we export versus what we import. So now we're going back to our GDP equation. Let's throw in net exports. Remember, net exports equals our exports minus imports. So let's call E our exports. This equals net exports. Okay, so we can again remember from the last couple slides, we said that this whole thing can be is just private savings plus public savings. That equaled investment before. Now we're going to add the trade balance in here, which is net exports. So national savings equals the investment plus kind of our trade balance. Remember our trade balance. So what is trade balance? Well, trade balance is how much we export minus how much we import. Specifically not how much, but what's the value of that. So if net exports is negative, then our national savings is less than the total investment. But if net exports is positive, then our savings is bigger than investment. So what does this kind of mean? This means if we're in the first case, case one here, then foreign savings is financing our investment. If we are in case two, that means our savings are leaving the country, financing investment in other countries. Okay, so let's look at some more graphs here. We have investment spending, and then we'll look at the budget deficit along with private savings, and then capital inflows. So we can compare Japan to the United States. Like we already saw, our investment spending is lower than Japan. That's what you see from the orange on the left. And then from the, again, we kind of see this is a pretty common thing. All governments kind of work in some sort of budget deficit. So this is pretty common, even for both countries. And then the private savings is huge in Japan compared to the United States. And then we have capital inflows, which means people are investing into our country. And in Japan, on the other hand, people are taking money from Japan and investing it in other countries. Okay, so let's go into the different types of capital now. So it's important to understand clearly the three different types of capital: physical, human, and financial. So physical is manufactured resources, so such as buildings, machines, uh, factories is a good example. Whenever I think of physical capital, I always think of factories. And before we've defined this using the variable K, so that's important to remember. Human capital is the improvement in the labor force generated by education and knowledge. And I believe we've denoted this as H before. So this is just your human capital, which is kind of like your workforce, improves. That's what we call human capital. So if we invest into a bunch of our schools and we make them a lot better, we put iPads in every single school, that's going to increase the human capital. And then the last thing is financial capital. So it's funds from savings that are available for investment spending. So a country that has positive capital inflow is experiencing a flow of funds into the country from abroad that can be used for this investment spending. So how does the savings of consumers get the firms to finance investment? For this, we're going to start using a model for our financial markets. It's not a very scary model. It's going to be a very nice, similar supply and demand type model. So the market for loanable funds is a hypothetical market that examines the market outcome of the demand for funds generated by borrowers and the supply of funds provided by lenders. So again, with supply and demand, it's always important to know which party is responsible for which aspect or which curve. If I am trying to build a factory to start my business, I am the one who is demanding funds because I want to build this factory, but I don't have the necessary cash on hand. So I am the borrower and I'm going to demand it. If I'm supplying it, this means I've saved a lot of money and I'm looking to invest it in a smart place so I can supply the funds to them. Okay. What is the interest rate? It's the price calculated as a percentage of the amount borrowed, charged by the lender to a borrower for the use of their savings for 1 year. What projects are worth investing in depends on this interest rate. So let's see. So interest rate just is simply, let's do an example here. So say we have Bob. Bob needs $10 to start his, maybe we'll make this a little more. He needs $100. He wants to start a lemonade stand. He needs $100 to get wood to make his lemonade stand and also to get the lemonade equipment, maybe some fresh lemons. And then there's going to be Jim. Jim is willing to lend, but he's willing to lend at a 2% interest rate. Okay, so what does this mean? So, and then we'll say maybe it's over 1 year. So Jim is going to give Bob $100. Bob is going to build his lemonade stand, and then in 1 year, Bob owes Jim the $100 back plus $100 times 0.02. And this is the interest part of things. Okay, so this comes out to $102. Okay, because if Jim is giving money to Bob, he kind of wants to get a little more back. Right? If a zero interest rate is like fine, but this means like Jim gives Bob $100, and then a year from now, Bob gives Jim back $100. So it's probably not the best way for Jim to invest his money, but if he can get back 2% interest over the year, then he's going to make $2 from this interaction here. Okay, so the rate of return on a project is the profit earned on this project expressed as a percentage of its cost. It's similar to our new minus old over old, and but it's a little bit, the interpretation is not the same. So the revenue from the project minus the cost of the project, this is also what we can think of as profit. Okay. So the profit divided by how much it costs, we multiply that by 100. That's what we call the rate of return. So if the return is too low, you're better off just sticking your money in a bank and earning interest. But if the rate of return is really high, then you're better off lending to this borrower. Okay. So here we have a demand for loanable funds. Remember, the people demanding these loanable funds are the people who are borrowing it. So when the interest rate is really high, this means Jim is only willing to give you this loan if he gets back 12%. Well, that's a lot of money in interest across a year. So my lemonade stand has to be super, super profitable for me to make it worth it. Whereas when the interest rate gets lower, I want to borrow more money because I can maybe use that money to open 3 lemonade stands, and that's going to make me a whole bunch of more money. And since the interest rate is really low, I'm comfortable doing that. Okay. So remember, the borrowers are the people who are demanding for loanable funds. This could be like businesses starting up, as an example of this. Another kind of example could be just like companies that have stock, that issue stock. So what they'll do is they'll give stock out and then they promise a dividend back. Or it could just be, I'm going to the bank to start my business, and the business says, here's your contract. And then you're going to pay us back 4% over a year. Another common one is houses. So like mortgages uh, for houses. So when we talk about the housing market, a big thing is we want to keep the interest rate low. Why is this? Because this means that people are more willing to spend a lot of money on houses. And this is all from the demand for loanable funds. Okay, on the other side, we have the supply of loanable funds. So who supplies this? Banks. If you've watched Shark Tank, Mark Cuban is a supplier of loanable funds because this is how they look at it. They look at it in the opposite way. If the interest rate is really high, this means I want to invest with you because I get paid back big. So for $450 billion, if I get a 12% interest rate, that means once this has been paid. Um, my investment will be 1.12, will be $504, which is pretty good. If I get 12% back over a certain amount of time, it's a pretty good investment for me to make. Okay. So we have a supply, we have a demand, and boom, we have our equilibrium right here. So in our equilibrium, we have $300 billion of loanable funds, and then we have our equilibrium interest rate, which right now is at 8%. So let's kind of look at like what's happening on each aspect, which is like above or below this equilibrium. If we're talking about this region right here, which is above the equilibrium interest rate, but it's for the demand, only projects that are profitable and interest rate of 8% or higher are funded, meaning they have to be pretty good projects, right? 8% is pretty high percent. So I have to be pretty confident that I'm going to be making back that money so I can repay this loan. So like this guy right here who has a really great idea, uh, he's going to start a great company. He's going to have no trouble finding a loan. This person, it's going to be a little more challenging, but he's okay with 8%. When we go down here to the bottom part of the demand, these are projects that are profitable only when the interest rate falls below 8%. So for this company right here, maybe they have a pretty good idea. They think they're going to make back a decent amount of money, but they don't think they'll be able to repay that interest rate of 8%. So they are just not going to get funded. And that business will like never be created. Let's look for the supply now. So if I am on this low aspect of the supply curve, offers accepted from lenders willing to lend an interest rate of 8% or less. So they obviously are going to be very happy with the 8%. For people who are up here, they're wanting a higher percent, so they will not be interacting in this market. Okay, very nice. So what shifts these curves? Let's start with the demand. So change in perceived business opportunities. If I believe that my company is going to be very, very good, maybe there's some regulations that were shifted by the government, and now I think my company is going to be more profitable. That means I'd be willing to borrow more money at a higher interest rate. Changes in government borrowing. So we talked a little bit about this crowding out effect. We're going to touch on it more here. So a government budget deficit drives up the interest rate, and then it's going to lead to reduced investment spending. And this is because the government is going to kind of crowd out a bunch of these investors. Um, so very nice. So both of these, when they increase the demand for loanable funds, this is going to increase the equilibrium interest rate. Okay, what shifts the supply? So things that can shift the supply, maybe it's the change in the private savings behavior or change in net capital inflows. Let's talk about this first one. So uh, if I live in a country such as Japan where net savings is very high, then this means there's a lot of people who are willing to lend money. So when there's a lot of these people, that's just going to quite simply push out the supply curve, which is going to lower the interest rate. All right. So let's talk a little bit more about this crowding out of private investment here. So when we increase the government deficit, what we're gonna do is let's see here. So the size of the deficit first can be characterized by this difference right here, because the government is going to be the one that's borrowing from these investors. So when the government increases their investment, or no, not their investment, when they increase the goods that they buy, the borrowing, what that does is it means all these other people that, um, like originally we were at this point right here. Now all of these companies they no longer are going to be able to borrow because the interest rate has gone up due to the government maybe taking loans for infrastructure or to construct new projects, all of the above. So what that does is it's going to raise the interest rate, where the government is just strictly pushing out the demand because now they're a big player in borrowing here. Okay. More about crowding out. So when total lending went up, but lending to firms went down, that's what kind of we characterize crowding out to be. Why does this make sense? Well, the interest rate rose, so some projects are no longer worth investing in. The government is going to be acting in this lending here, as in they are going to be the borrowers. But what it's going to do for the companies is it's going to take away all the lenders that would invest to them. And instead of investing with them, they're just going to invest with the government. So how much it went down depends on the shapes of these curves. So if savers are willing to make new loans, crowding out will be small. If there's only a fixed quantity of savings available, crowding out is 100. And this is bad for growth. What do we mean by crowding out is 100%? So if there's not a lot of people that are saving, willing to lend, and the government comes in and wants to take all of those lenders' money for their own investment, then that's going to leave nothing for businesses that are going to start up. And when you don't have businesses starting up, this is bad for growth because they can't do anything. They can't start their business. They can't contribute to the GDP. Let's talk about now inflation and interest rates. So anything that shifts either the supply or the demand of loanable funds curve is going to change the interest rate. We talked about this. And historically, major changes in the interest rate have been driven by many factors, which include changes in government policy and then technological innovations that created new investment opportunities. But the most important factor affecting the interest rate over time is changing the expectations about future inflation. So this shifts both supply and demand for loanable funds. And this is a reason, for example, the interest rate today are much higher than they were in 2016 to 2020. So generally, when the interest rate is high, inflation tends to be low. And then as the interest rate drops, inflation increases. This is kind of like the common correlation we see. So remember, when we talked about real GDP, this means it's adjusted for inflation. So the real interest rate is the nominal interest rate that you would see, such as like 7, 8%, minus the inflation rate. So for example, the inflation rate was around, I think it's maybe not 5, maybe it's like 4-ish% right now. And the nominal interest rate is about like 4.3%. Okay. Um, so right now the real rate is maybe about 0.3%. Meaning, so why is this important? Like, if I'm going to lend to you, then I have to take into effect inflation because I can always put my money somewhere and get an interest rate that's basically equivalent to the inflation rate, so I'm not losing any money. So when the inflation's really, really high, I have to get a big return back for me to make it worth it. When we sign a loan contract, we use our expectations of inflation to adjust to the nominal rate and making our decision based on the real rate. So in the real world, neither borrowers nor lenders know what the future inflation will be when they make a deal. Actual loan contracts therefore specify nominal interest rate rather than a real interest rate. So yeah, when you see a loan contract, it's always in a nominal interest rate. And then we talked a lot about these expectations of inflations. Why is that important? Because a lot of these contracts are like, you are going to give us 8% and you're going to pay us back over 4 years. And you're going to sign that right now. And then in 4 years from now, you're just going to pay us back 8%. So we have to anticipate what inflation is going to be to see if that deal is going to be worth it for us. Okay? So let's talk about the Fisher effect. The Fisher effect is an increase in expected future inflation is going to drive up the nominal interest rate, leaving the real interest rate unchanged. Okay? So if I expect the inflation to be higher in the future, I'm going to charge a higher interest rate today. And what this is going to do is the expected real interest rate is going to be essentially unchanged. They're kind of going to cancel each other out. So this would mean changes in inflation expectations don't change real interest rates, and thus they don't change borrowing and lending. Um, so let's look at what's going on here. So we go back to our graph that we've talked about before. This is the nominal interest rate. Okay. If we expect 10% inflation, so we go from E0, and all it's going to do is it's going to shift the supply and the demand vertically, and then it's going to make it so it's okay that we take a 14% nominal interest rate because we know that we have a 10% expected inflation in the future. So theoretically, it should not affect our quantity. Okay, now let's look at a graph here. We have this nice COVID little shock going on right here. We have billions of chained 2012 dollars, and then real disposable personal income and consumption expenditures. So they rise about the same. And then we had this big shock, but now they're back on a similar trend. Very nice. Okay, so shifts of the supply for loanable funds. Factors that can cause the supply of loanable funds to shift include the change in the private savings behavior. So between 2000, 2006, rising home prices in the United States made many homeowners feel richer, making them willing to spend more, save less. This shifted the supplies of the loanable funds to the left. And then capital inflows. So the United States received large capital inflows in recent years, much money coming from China and the Middle East. These inflows help fuel a big increase in residential investment spending from 2003 to 2006. And as a result of the worldwide slump, these inflows began to trail off in 2008. Okay, so capital inflows, I've kind of skipped around it a bunch, but capital inflows are, this is just investment from outside my country to my country. Okay, nice. So government budget. If we have a budget balance, the budget balance is the difference between tax revenue and government spending. If we have a surplus, then tax revenue is bigger than government spending, meaning that our public savings is bigger than zero. A lot of times we've been in a budget deficit. We are still in a budget deficit. We will be in a budget deficit for the foreseeable future. The last time we were in a surplus, Bill Clinton was president in like 1990. I forget the year, 99 maybe we were in a, I forget, 94. I'm not great with that history. But that was the last time, was when Bill Clinton was president. We had a budget surplus, but since then we've been in a constant budget deficit. How do we finance this deficit? Well, the government will borrow. So the government borrowing is the total amount of funds borrowed by federal, state, and local governments in the financial market. They do this through bonds, treasury bills, all of that. So trade balance is the gap between a nation's exports and imports. It's also called the current account balance. I like trade balance better though. I think it makes more sense. So trade deficits can be a good or a bad sign for an economy. Trade surpluses can also be good or bad. Even a trade balance of zero, which means that the nation is either a net borrower nor lender, can be either a good or bad sign. So the fundamental economic question is not whether a nation's economy is borrowing or lending at all, but whether the borrowing or lending in the particular economic conditions of that country kind of, if it makes sense. So just because we have a positive trade balance, that doesn't mean we are uh, the economy is soaring. And if we are net importers, which means we have a negative trade balance, that necessarily does not mean we are soaring either. It kind of just depends. So more definitions here that we got to get through. Investment spending is the spending that adds to the economy's stock of physical capital. The current account balance is technically the change in the value of a country's net claims on the rest of the world or the change in its foreign assets. Just think about it as exports minus imports. It's just the trade balance. Okay. And then the capital account is the records the net sales of assets to foreigners. So it's just the current account is just the inverse of the capital account. The current account, say we are importers, so the current account is minus 100 billion. Then the capital account should be 100 billion. Easy, nice. Okay. Merchandise trade balance. So it's the balance of trade looking only at goods. And then unilateral transfers are payments that government, private charities, or individuals make in which they send money abroad without receiving any direct goods or services. So this is we export computer chips through like Intel. We export a bunch of other things, but like people import a lot of apparel. Uh, what's the hot thing? Labubus. All those things are made in different countries and they come into the United States. This would all be in the merchandise trade balance. The unilateral transfers are payments that the government, private charities, or individual. Blah, blah, blah. So this is like investing into a certain country. There was a bunch of money that just came in from like the Middle East. I don't know. Okay, let's move on. Let's talk about the current account. So current account is just income plus RB. So where RB is the interest earned on foreign assets acquired previously. R is the interest rate, so it's actually R times B, which this is the amount of assets acquired previously, minus consumption, government spending, and investment. Savings, given right there. So using these two definitions, we have the current account is equal to savings minus investment. This is called the savings investment identity. It's a pretty common identity. If you've taken maybe a accounting class, you've seen something like this. So if we have a closed economy, the current account is zero. So there's no trade, and this would give us our savings investment identity, which just means S equals I. We've already talked about this, but now we have the current account, which kind of adds to this in a way. It means it so that savings doesn't always have to be investment. So investment spending in open economy. So assume exports and imports are allowed. Okay, I'm back. Sorry, I had to take a little break there. This slide kind of just summarizes stuff that we've already talked about. I'm not going to go ahead and read it all. If you want to read it all, well, you can pause right now. But yeah, let's just keep moving. All right. So let's talk about the connection between a trade deficit, which is a current account deficit, and capital inflows. So if you have capital inflow means money is coming in via investment, and a trade deficit means money is going out, meaning that we are spending more money, but that money is going to different countries via buying their goods. Um, These things have to be balanced. Money goes in one way and out another. So what's kind of important here is if your imports are bigger than your exports, you're receiving capital inflows, meaning you have foreign investment coming from elsewhere. Every country eventually runs a surplus on account of having run a deficit and vice versa. Okay, let's go back to a little more math here. So we have national savings and our investment identity. The supply of financial capital has to equal the demand for financial capital. Supply equals demand is going to be a common theme of this class. So the supply here is the savings by individuals and firms. And then we are going to add this net exports, which is also going to be called like our trade deficit. We call it a trade deficit if this number is negative. That's going to equal the private sector investment plus the government minus taxes collected, which you can think that is your government deficit, meaning like if the government spends $10 but only gets $6 in taxes, they're in a deficit of $4. So these things have to equal each other out. Okay, so here's kind of an example for us. So we can use the investment identity to answer the following question. Country A has a trade deficit 200 billion. They have savings of 500 billion and private domestic investment of 500 billion. What is country A's budget deficit? Okay, so we can just use this equation right here. So they have a trade deficit of 200 billion, meaning imports minus exports equals minus 200. Furthermore, we know that the private domestic savings is 500 billion. So that goes right here. And this has to equal the private domestic investment, which is going to be 500. And then this is minus the government minus plus the government minus how much taxes we do. Okay, so we can cancel all this out. You get minus 200 equals government minus taxes. Remember, this is the government spending minus how much taxes we bring in. So we have a government budget deficit of 200 billion in this case. Remember, we would have a government surplus if this number was plus 200. This number right here. But it's minus 200, meaning the government spends 200 billion more than they collect in revenue. Okay. So if the government collects more than they make in taxes, the government would be a demander of financial capital. And if the taxes are bigger than the government spending, then the government would contribute as a supplier of financial capital. So in the case of a trade surplus, the national savings and investment identity can be written below, where you have the total surplus equals the private domestic savings plus the public savings minus investment. That's what's written right here. Domestic savings is higher than domestic savings. Wait, domestic savings is higher than domestic investment. That extra financial capital is going to be invested abroad. Okay. So the national savings and investment identity also provides a framework for thinking about what will cause trade deficits to rise or fall. So you have, again, we have our equation, and then what we are doing in the table below is we can see what happens if we change one thing and keep everything else constant. So if we just increase the domestic investment, that means our trade deficit must rise, or M minus X, imports minus exports. Yep. And then if we raise the private domestic savings, then our trade deficit decreases. And if we decrease the domestic savings, then the net trade deficit will rise. Okay. Very nice table. Again, using this table, all we're doing is we're changing one thing. So, for example, in this first one, we say investment increases. This is the same. This is the same. What must happen here? Well, this must also increase. That's all we're doing with this table right here. Okay. So if imports is bigger than exports, then investment must be higher than savings. So if a country has the exports bigger than the imports, it's going to begin to invest the money it saves from this abroad, which is what we call financial outflows. So in case of a trade deficit, the national savings and investment can be written again, as below, the only way that a domestic investment can exceed domestic savings is if capital is flowing into a country from abroad. Okay, so this equation is just the exact same as this equation. We just wrote it in a little bit of a different way. This is a good one to know. Um, Good one to know. So for your midterm, everything will be on Zoom. I'm not going to assume that you just have Zoom up and nothing else up. If you have a formula sheet right next to you while you're taking your exam, that is okay. This would be a good equation to throw on there. Okay. Um, so kind of like wrapping up all of our equations that we've talked about, the net capital inflow is just going to be the imports minus the exports. And then we also have our investment spending, which is the national savings plus the imports minus exports, which is also equal to our total investment. This is going to equal the national savings plus the net capital inflows. Very nice. So in the short run, whether an economy is in a recession or an upswing, uh, this can affect trade imbalances. A recession tends to make a trade deficit smaller or a trade surplus larger, while a period of strong economic growth tends to make a trade deficit larger, or conversely, a trade surplus smaller. Okay. So this is again kind of just what we found with recessions and trade balance is a big correlation. This is kind of how recessions interact with this trade balance. So for countries, there's no economic merit in a policy of abstaining from participation in these markets. It can make economic sense for a national economy to borrow from abroad as long as it wisely invests the money in a way that will tend to rise the nation's economic growth over time. So, example of this, US in the mid 1800s and South Korea in the 1970s. A borrowing nation can find itself in trouble if it does not invest the incoming funds from abroad in a way that leads to increased productivity. Examples are Mexico, Brazil, and some of the African nations in the 1970s and 80s. So essentially, if you're getting all this money from abroad, and you're not pushing it to increase productivity, maybe in a lot of these countries, there's examples of corruption going on. And so these funds are not allocated towards increasing productivity of your country. This can put yourself in trouble. This is not a good thing for growth or the just well-being of your nation. So a credit default swap gives us a glimpse into how poorly a country manages its debt. So the higher the price, the higher the possibility of default. Here's some countries and the credit default swaps rates for a sample of specific countries. You see UK, United States, they're pretty low. I'm not sure when these were taken. I think this was probably taken in like 2022. Mexico, Brazil, and Egypt very high, which means that their funds are not invested wisely. They were not put into the productivity of their nation. This can also be like a sign of corruption in a way. So now let's talk about the trade deficit. That's been a hot topic in the political landscape today. Is it a bad thing? No, not really. It's not necessarily a bad thing. So for much of the 19th century, the United States ran a trade deficit. We still run a trade deficit even to this day, and it resulted in a large inflow of foreign capital. The capital was used to finance critical pieces of infrastructure like the railroad. It's also used to help improve roads. Infrastructure, meaning this is mostly like roads, railroads, light rail is a good example of infrastructure that we have in Seattle. Without this foreign capital, it's likely the construction of these railroads, to the extent which they were built, wouldn't have been possible. So trade deficits can actually help us in a lot of ways. Is being in a trade surplus a good thing? So it's looking at the flip side. Not necessarily. So Japan has a huge trade surplus. They had a has had a huge trade surplus for many decades, and they've been in and out of recession since the 90s, averages a 1% growth rate per year, along with a steadily increasing unemployment. Okay, let's look at indicators, I guess, here for are you doing well or not? 1% growth rate, not great. 3% is what we would think to be good, but anything that's below 3 is not great, especially for a super developed nation such as Japan. And then increasing unemployment, obviously bad. So Japan has had a high level of domestic savings, which is largely responsible for its trade surplus. It's kind of just a characteristic of Japan, is what a lot of economists have concluded. A lot of people from Japan just prefer to save, not spend their money, whereas in the United States, we have a very consumer-faced nation, meaning that like we get a lot of money and then we spend a lot of that money on goods. So when we're in that kind of sense, that means it's good for the economy, as in a lot of new companies can start and expect to generate money from our consumers. In Japan, it's a bit harder for people to get to spend their money. Okay. So a country's level of trade tells us how much its production it exports. Separate term than the balance of trade. It measures as a percent of the exports out of the GDP. Three factors strongly influence a nation's level of trade. What's the size, the location, and the history of the trade? These all kind of make sense in some ways. If you're in Antarctica, it's very hard for you to trade because it takes a lot of effort. There's ice that gets in the way, and people have to go through ice to get to export anything. Whereas if you're maybe in Europe or the United States, it's pretty easy to get around to trade with a bunch of neighboring nations. So here are the top 5 countries in terms of the level of trade. Luxembourg. This is what I was looking for. They, this is the country that has the highest GDP per capita. Because they have a lot of really wealthy people. They still have a small amount of really wealthy people, and it kind of drives up their GDP per capita. It's a bit of a shock if you look at it, because you wouldn't expect them to be up there. Hong Kong, Singapore, San Marino, and Djibouti. I don't know how to say that right, I don't think. The United States, which is the richest country in the world, ranks 181 out of 193 countries measured, 2.1 trillion. And then China also ranks pretty low, and Germany, which is the third richest nation, is kind of like a little bit middle of the pack in this level of trade. So let's look at the components of the US current account. So we have goods, these are the value of exports, money flowing into the United States, and then the value of the imports, which is the money flowing out of the United States, meaning goods, exports, things that the United States sends to other countries. We have a big deficit when it comes to goods. When it comes to services, we have a big surplus. So a service could be Netflix is a service, consulting is another service, and a lot of tech that the United States makes, those are exported to other countries. Those are we call those services. So income, receipts, and payments, we have a small surplus. And then unilateral transfers, also you see the number gets smaller and smaller. We have a small deficit. So our current balance account is negative 616.1, and I believe this is in billions. I believe it's in billions. Okay. So current versus the capital account. So the flow of goods and services, the top lines one and three, show up in the current account. Flow of funds, which are the top lines two and four, show up in the capital account. And then investment income, which is the bottom two lines, show up in the current account, where investment to the rest of the world or into the home country, which is bottom lines one and three, show up in the capital account. It's kind of a nice little visual of what we mean when we talk about the current and the capital account. Remember, it's also kind of important that the current equals the minus of the capital. So if your current account is 10, your capital account would be minus 10. Okay, just a couple exercises for us here, and then we are done with week 4, and you don't have to listen to me until after the midterm if you don't want to. So exercise 1, explain why an increase in the government budget deficit could lead to an increase in investment by firms. So what's going on? We have a decrease in the government budget deficit, meaning this means that the government they spend less, right, compared to how much taxes they bring in. How could this lead to an increase in investment by firms? Okay, so I think a good way to do this is we can look at our demand and our supply for loanable funds. This is a loanable funds graph. Okay. When the government spends less, this means that they are not crowding out of they're crowding out less of the economy. Okay. So remember, we had this picture earlier where we had the government spent more, and then we had like this demand increase, but then we had this problem because we looked something like this. So this is like this level right here. This was government spending, and then they spend with like this extra money that they have, and it kind of crowds out a bunch of in investment, right? Or it crowds out a bunch of people who want money. So when this decreases, say this goes all the way down to zero, now we're dealing with this demand, and the interest rate has lowered, and then the quantity has increased, meaning the quantity that individual firms will get to in not will get to borrow. Okay, so your answer looks something like this. Big things here is the interest rate you would expect to go down, and then the quantity for private borrowing would go up. Very nice. Okay, so suppose that because of a rising price level, consumers starts carrying more of their wealth as cash in order to carry out transactions, thus are less willing to put their wealth into other assets like stocks and bonds. Depict this effect that this will have on the market for loanable funds. Explain what will happen to both the interest rate and investment. Okay, so again, we have the supply and the demand, quantity, and the interest rate. We have this rising price level, and so consumers start carrying more of their wealth as cash, so they do not want to invest this. They're scared to invest this because inflation could go way up, and then they could be making a terrible investment, losing money in the long run. So instead of putting their money into this lending, what they do instead is they just keep it for themselves. So keep it in cash. This is just going to shift the supply of loanable funds because people are less willing to do this. What is this going to do? Well, it's going to, I'll call this I1, I2, Q1, Q2. It is going to increase the interest rate, and then the quantity of investment will decrease because now people are less willing to give their money. So for them to be able to give their money, they're requiring a higher interest rate. So all this is doing is we're shifting the supply. Okay. And we're done. Okay. So we're done with this financial markets and loanable funds. Now you have all the tools that you need to prepare for your midterm. So make sure you get your writing assignment, which technically is due after the midterm, but I would suggest doing it before. Start studying for the midterm, finish that reading quiz 10, and then you should be in good shape. I will post a lecture next week, which is the week of the midterm. However, that will be you won't need to watch that until after the midterm. And honestly, since there's no reading quiz after the midterm, I would suggest you wait till after the midterm to watch that video. So I will probably see you during the midterm, which is going to be taken live at 3:30 p.m. on Zoom on July 23rd. Just let me double check this so I don't. Yes, yes. So July 23rd, I will see you on Zoom. Look for some Canvas announcements. Start practicing with the midterms. So maybe I'll see you in office hours or I will see you for the midterm. So good luck studying and I'll see you guys then.